So it seems like almost a lifetime ago, but the quarter began, of course, with a very brisk sell-off in the days after Liberation Day, right? So when the Trump administration announced some very punitive tariff rates on many countries around the world, markets sold off very briskly. But ultimately, in the days that followed, the administration walked a lot of that back, put in some significant delays in implementing those tariffs, allowing time for negotiations. Markets rallied from there and then continued through the quarter to really climb that wall of worry around tariffs, around geopolitical risks. As we ended the quarter, markets were up a fair bit, pushing towards all-time highs. As we look out through the second half of the year, I do think that markets will continue to push higher. That there's a number of positives out there, a tax bill that's making its way through Congress, ultimately lower taxes for corporations, a positive for markets. We'll get more certainty on tariff rates and where they eventually land. You know, tariff rate around 10%, ultimately like a tax that markets can continue to get some comfort around. That could be a positive. And then finally, we may be able to see the Fed begin to resume rate cuts as well. Again, a positive for markets. So despite all of the ground covered by equity markets, as well as huge volatility in rate markets, the most notable moving asset for me was the US dollar. So the US dollar had been sliding through the first quarter on a broad trade-weighted basis, down around 3% in the first quarter, but continued that slide, accelerated through Liberation Day, and really did not recover, continued with that downward bias. The broad US dollar now down around 9% for the year. So again, this kind of points to the idea that all of this policy uncertainty in the US has made global investors kind of rethink their positioning, start to broaden out their investments to other parts of the world, which has been quite beneficial to portfolios that are already well diversified on a global basis, such as our Granite portfolios. So on the equity side of our portfolios, we remain fully invested and very broadly diversified on a global basis. One of the themes that's worked out well this year, I do think will continue to play out in the second half as investors look to be more diversified on a global basis. On the fixed income side of the portfolio, I think credit will hold up relatively well, and our core exposures in high quality fixed income will provide a good hedge in the off case that the economy begins to slow to a greater degree than we may expect at this point. From a tactical perspective, we have positions in gold. Gold in particular has been a good hedge against many of the risks of policy uncertainty that we've seen out there, as well as this move away from the US dollar. Gold has been a beneficiary on that. In certain portfolios as well, we hold positions in crude oil. Again, a good hedge against some of the geopolitical risks that we see. So active management has benefited the portfolios in a few key areas this year. Our global listed real asset exposure, as well as our global small cap and global bonds, all have seen net contribution from an active management perspective. On our tactical process, an overweight position to gold as well has been a really strong beneficiary to the portfolios. And going forward, where we think there's still plenty of uncertainty, whether you think about where policy may land from a monetary policy perspective from here, where we may end up on the tariff side of the equation, still plenty of geopolitics, and ultimately we've had a very strong run for markets. So we can expect to see even a short-term correction along the way in the second half. All of those setups tend to favor active management, which we think will benefit holders of the Granite portfolios.